Welcome to the Dividend Talk podcast, episode 193. Google initiates its first dividend and lots of earnings.
Dividend Talk is your number one podcast for all things dividend and stock market related, community oriented and with a European flavor. However, for those of you interested in delving deeper into specific topics, we also offer a premium service. This service is centered around our newsletter, featuring in-depth analysis and special subscriber requests, but also offers dividend safety stock cards, 50 already, access to our beta dividend safety dashboard, and an e-learning course on how to interpret the 3 financial statements. If you haven't become a member yet, feel free to sign up for only €119 a year. Having said that, we would really like to extend a warm welcome to our latest subscribers. But let's get started. In today's show, we would really like to discuss the announcement of Alphabet's first dividend, followed by several other earnings discussions. For instance, a much requested one about Bristol Myers. Is this an opportunity or a value trap? As usual, we also addressed many of your listeners' questions. Ready? Let's get started and enjoy the show.
Hey, European DJ, we've got a jam-packed show tonight. It's going to be a good one.
Oh yeah, definitely. And you just mentioned it. Google issued its first dividend, so we have to talk about this one specifically after Meta, Facebook, Mark Zuckerberg. Actually, there was a picture going around on the internet that showed Mark Zuckerberg like totally white, like an alien, and then later like a little bit of a beard, a bit brown, like a nice necklace around the neck. And I was mentioned there like before and after he initiated the dividend.
I'll
So
see.
no, really good. Of course, we are busy at work, but we have Majovka coming up here. It's a May break. I think in many countries in Europe, we will be celebrating Labor Day. I think in the Netherlands tomorrow they have King's Day. So I wish everyone already that tuned in to today like a lovely week, because at least over here in Poland, it will be 20 plus degrees. So I'm really looking forward to it.
Yeah. And let's maybe talk about Alphabet a little bit more, because I think when Meta initiated its dividend, I have to listen back. I can't remember if we said Amazon or Google would be next, and we were wondering which one would follow suit, and it looks like Google stepped up.
Yeah, we said it several times that Google should come, right, with the cash and everything on hand. And we said it a few times in the past. It just came out of the blue for me. I didn't expect it now. I think, I mean, in any case, you can't predict it, of course, but it just took me totally by surprise. But hey, I'm happy. I'm a Google shareholder. I was also a Meta shareholder, but I also sold it. I got quite some questions around this because I also made kind of a joke at the on Twitter saying like, "Hey, I sold it at 500 and reinvested it in Hershey as an example, just for fun." But then there was a lot of questions like, "Why did you sell Meta?" And maybe to clarify everything, and I mention this more often, I've got 10% of my portfolio non-dividend stocks and some stocks that I think are undervalued. I bought Meta at $170 or something like that, and it went even after that to $80. And I just found it undervalued. I saw the cash flow. Then it bumped up to 350. I sold half, and then I usually I play with the house's money, right? As they say in the casino.
Yeah.
But then when it went to $500, I thought like, you know what? It's not yielding me anything really. I didn't buy it for a dividend growth stock. I wouldn't buy it today as a dividend growth stock either. I don't have such strong conviction on Meta for the next 10 years. As such, I think let's say differently. You see how easy TikTok was able to create a total new product and such. So I think it has a relatively narrow moat compared to Google, as an example, who has the whole search, YouTube, everything. So yeah, if you don't have that strong of a conviction, and then you see Hershey coming towards the 3% yield, and then it was an easy one for me because I invest for income. Yeah,
Yeah.
not for capital appreciation as such.
And what about Alphabet? You do own Alphabet, I believe.
Yeah. Alphabet, I own them already for quite some time. I think they went 3 or 4-fold for me already. But I just like the company. I always liked it. So it's one of those companies that, like Microsoft for me, that I just want to have in my portfolio, and it stays in the 10%. Well, it goes now into my normal
Yeah.
one, but I don't own this one for the dividend. Let's be clear. Maybe the dividend will grow into it. That's
Yeah.
nice, but it was never my reason for buying, and let's see how that goes.
Yeah. Because
Dividend initiators tend to do well.
that was going to be my next question. What do you do now? Do you make space for another growth company in your 10%, or are you just going to
Well,
still
I
class
made space by selling Meta, right? So I can now, and
with
then,
your
by the way, it's not 10% anymore because my portfolio got too big. I don't want to waste so much money on my value plays because not everything plays out well.
yeah,
No, I would just continue to own Google for the long term. I also don't find them heavily overvalued or something like that. They're growing nicely, so I see no reason to reduce it and take my profit out. Again, I wouldn't have sold Meta if I would have had strong conviction for it. I really saw it as a value play. Of course, I saw Google also as a value play when I bought it, but I still have now very much conviction about it. So that's the reason why I'm not selling it.
yeah,
For the dividend, I mean, it's going to pay 20 cents dividend per share. So that won't make me rich overnight. Of course, I appreciate all the little things. I do expect fast dividend growth because it's a very low payout ratio. And maybe a little bit more about that because we got questions from 18 Beer Schneider about this, Oleg, Frederick, Luis. They were all asking about this, right? So maybe really quickly, like Google, actually they increased their revenues 15% year over year. Yeah. Their cloud division is on fire. Really, the earnings per share went from 117 to 189. I mean, these are growth numbers, right?
yeah,
Then if you look at the balance sheet, they have 111 billion in cash and cash equivalents on the balance sheet. Yeah. They also still have almost 50 billion in accounts receivable, while they have only 7.5 billion in accounts payable. Yeah, they do have some expenses still there that they need to pay and current liabilities. But remember, 110 or 111 billion in cash and cash equivalents, 13 billion in long-term debt. So this is such a rich, wealthy company that, yeah, they were already late with initiating a dividend.
yeah,
They've just been repurchasing shares, but I think it's good that they started now also with a dividend because, for instance, they had about in quarter one around, let's see, 16.8 billion in almost 17 billion in free cash flow, and they used almost 16 billion to repurchase shares. That's a lot. It's, I think, almost a 2 trillion company.
yeah,
So it's a lot of money. I think not even 1% in the end. But yeah, I think there's enough space for starting to initiate a dividend and maybe scale down a little bit the repurchasing of shares. I mean, I like both, right? But I prefer the dividend, of
yeah,
course.
of course.
Here.
So we got two kind of questions which I think are interesting, and 18 beers. I love that name. First of all, right? 18
Yeah.
beers and Oleg have asked these two questions, and the first part is, do you think that there'll be a long-term dividend growth? And I've emphasized the growth there because their dividend policy are, let's say they don't have a defined dividend policy other than saying that they intend to pay a quarterly dividend.
Yeah, but this is like what most
Yeah.
American companies have. We
So,
studied them. This
so
is
do you,
typical.
so
Yeah,
you,
I
you
expect long-term growth. I can really see. I mean, I understand a little bit the IT world, and I also understand Google Clouds. I know it's winning popularity also in the corporates.
yeah,
It's a bit of a cheaper alternative typically as well.
yeah,
Not with every cloud services, but with some of them compared to Microsoft. They've been heavily investing in it in the data centers. I remember a few quarters ago that the stock got hammered for their capex. Yeah, now it's paying back. Yeah, now
yeah,
you see that they were investing in for the future. So yeah, I see also YouTube still growing. Um, I've no reason to think that this will start declining anytime soon. Of course, it's a bit more sensitive to an economic crisis or something like that because of the ad
Yeah.
spending. I am a little bit, I said, concerned that Google Search will lose its power due to generative AI popping up, which will answer questions that you would usually go to Google for. But I think this will be easily compensated by all the other business lines that start to catch on at the moment. I
Yeah.
mean, easily is maybe too big word. So yeah, I think
Okay.
we could easily see, no, not easily again, but I think we could. I wouldn't be surprised if this one will become like a dividend aristocrats with 25 years of growth. With Meta, I really have my doubt. I think that Meta can be so easily replaced by another technology that creates a quick network effect.
Yeah.
Yeah, of course, we as boomers are on Facebook and everything. We won't quickly leave there.
Yeah.
But I see from my behavior already that there's so much spam on my timeline, and I'm not so much on Facebook other than in our Dividend Talk group, of course. That's where I
Yeah.
spend most of my time.
Okay. So based on that synopsis, and they have the potential to be a Microsoft in terms of their dividend growth. Would you wait for a track record? Let's just say you don't do Alphabet and you have a little bit of FOMO, you want to own this stock, but they pay a dividend and now they're a dividend company, you're all excited. Would you wait for the track record of growing dividends, or would you bite the bullet now and go
I
through?
think this is a dividend initiator, very safe dividend if you look at the balance sheet and everything. So I I don't think they will next year, for instance, decrease the dividend. This is not behavior of dividend initiators. So I think you can safely assume that they will grow the dividend. Really, why else pay a dividend like that with the intention for quarterly?
Yeah.
Why would you do that otherwise?
Yeah, I agree with you, but if I was to answer Alex's question directly, would I wait for a track record? I probably would wait 1 or 2 years because I don't know what the growth rate will be. It could be low, it could be high, it could be we don't know.
Yeah.
There's no clear policy. We're making assumptions here based on
Yeah, but I wouldn't even consider now if I didn't have shares in Alphabet.
no.
I mean, at this yield, it's not even attractive if you're investing for income. There were better times, when the stock was under pressure. I'm sure those times will come again because it's not the best managed technology company, Google, compared to, for instance, Microsoft. Yeah.
The start of 2023, I recall it was
Yeah, I find the CEO mediocre. Yeah, it's a little bit too Buffett like. You can have anyone running a well-managed company. Yeah, and it will take a while to damage it. And this is how I see Alphabet as well. I mean, he's doing his job. He's doing good, the CEO, but I don't feel that this is like excellent compared to someone like Satya Nadella. I mean, it's yeah.
okay. So that was a big piece of news of this week. So we had to touch on it. What else? What else has there been?
Well, of course, I have to talk with you just simply because you're a big Liverpool fan. I'm a Feyenoord fan from the Netherlands, and you're getting our coach. His name is Arne Slot, and they are very much in negotiation at the moment. Even Jurgen Klopp responded on the press conference to it that this would be a great coach. So you're a lucky bastard getting him.
So tell me, will that mean you'll become a Liverpool fan and stop bugging me about Manchester United now?
Maybe, who knows? They have both the red collar.
Yeah, look, I have to say I don't know a whole lot about Arne Slot other than what you see on YouTube, but as soon as he's announced, you as a fan, you look him up. But following Jurgen Klopp is no easy feat, and I
No, it's
wouldn't.
like Alex Ferguson.
Yeah,
I mean,
I would not like to be the man to follow him. So look, he has a big pair to step forward and to take on that challenge. And
but
if he
Derek, this guy can at least say that he coached Liverpool in his life. Whether it will be bad or not, he can say it. How often do you get a chance in your life?
man, Roy Hodgson can say he coached Liverpool and he did a horrendous job.
Yeah, but he
Uh,
can say he coached Liverpool.
like, David Moyes was tarnished for years as a bad
Yeah,
manager.
but think about Arne Slot. Think about he comes from the Netherlands. Yeah, in the Mickey Mouse League. uh,
That's not
takes
true.
the title, but it's still, yeah, we call it the Mickey Mouse League, yeah. And he wins the title last year, this year the cup, as a strong track record. But come on, Liverpool, if you can be a coach at a potential champion this year
Yeah.
of the Premier League, I mean, you don't decline that.
No, no.
Simply,
Look,
you don't.
look. You have to back yourself. But if Arnie listens to our podcast, the only advice I would give him is he needs to connect with the fans. And if he connects with the fans and get them on side, win,
Yeah.
lose or draw, they will stick with him. But
Yeah, I think he has that potential. He has that potential.
so enough about this football malarkey. This is dividend talk, not football talk. You have a
Yeah, but
comment.
Arne Slot will pay dividends to Liverpool. But yes,
We'll see.
another news item maybe
We'll
that I
see.
really wanted to bring under your attention. You know this French company, TotalEnergies, right?
Of course.
Remember that we were talking about Shell,
Yeah.
potentially listing them on the New York Stock Exchange. Well, the CEO had an interview, I think yesterday or today, with Bloomberg, and he had two comments that were very, very interesting for me, and specifically from a company like TotalEnergies. He said, first of all, the world must adapt to warming. Yeah. However, he thinks that the demand likely to remain above 100 million barrels a day into 2040. So 16 years at least still of very high oil demand. And that's very interesting to see, right? Because so far, what we can say about the transition of energy, the oil majors have been right with the pace. Yeah, I think the ones that are really pushing this climate change, the activists, I think they're just a little bit too positive. And I get it, but when you look at the reality of how easily you can change, of course you could argue like it's not in the oil majors interest to move quickly either, and they
Right.
do have some influence, of course, but nevertheless it just shows like um, that those companies are at the moment kind of proving right, that this sell off and the multiples that they gave them, the low multiples in the past, were a little bit like too early. The oil is dead narrative was too early. And I wouldn't be surprised if indeed this 100 million barrels a day will stay for the next 15, 16 years.
Yeah.
Yes, EVs will come. They have a certain percentage of what gets produced out of a barrel. And it's becoming more and more popular. The price war that's coming up now, batteries are getting longer, but it takes time to transition. It takes
Yeah.
time.
Infrastructure, everything. I mean,
Yes, and there's legislation now that per 2030, I believe no oil cars may be produced anymore. But guys, there's so much more than this, right?
course.
I think also about the planes. Think about the clothes we wear, the asphalt, everything. Everything to get oil out of society will take a very, very long time. So yeah, and then he is also he mentioned also that he's considering as well to list in the US. He said like we are facing a situation where European shareholders either they sell or maintain, and US shareholders are buying. So what is most convenient for US shareholders? Do they prefer to have the shares being primarily listed in New York or in Europe? I think when you ask the question, you have the answer. This is just a giant middle finger to Europe, because what he's referring to is, of course, all those European pension funds that say we cannot buy an oil major anymore. So he says they're not buying it in Europe. So if our shareholders are mainly buying in the US and buying from the US, yeah, then just list it in the US if Europe is not interested in our business anymore.
It's a second big company. I know CRH did it, but I wouldn't classify them as a big company compared to Shell and
Yeah.
TotalEnergies. And this is so untypically French, if you think about it.
Exactly. That was what surprised me the most.
I mean, I would get it if it was coming from a UK company or from a Spanish company, but a French company it's so untypical for them to say that.
Yeah.
But they are right, and I have to say this: it does point a big giant finger at this ETF rules we have over here with these unit trusts. I don't think it's working because the funds cannot buy. Nobody's buying the funds.
Yeah.
So, I mean, I think it's all blowing up, and I don't blame these companies for moving to the States because that's where
Of course not. Of course not. If ESG leads to nobody buying your stuff in Europe, then go to the country where they want to buy your shares, where they
exactly.
want to participate in the wealth you're creating.
Yeah, yeah. So I think Europe are going to have to stand up and take notice at some point.
Yeah, I think as well. And of course, we look at it from a capitalistic point of view, and rightly so, because we are capitalists, right? Um, uh, I just find it pity if such companies would find a listing elsewhere. We can do this in Europe. We should just, be a bit more realistic in all we do.
Yeah.
Good. Let's have some more positive news because I get already annoyed and angry, as you can hear.
Okay. I know what will cheer you up. Dividend hikes. That will always
Exactly.
cheer you up.
Exactly. A
We do
dividend
have
hike a day makes my worries go away.
it's what the doctor ordered.
Exactly.
We do have a couple. It was quite there for a number of weeks, so it's starting to pick up again. Thankfully, Cisco Corporation, ticker symbol SYY, hikes its dividend by 2%, which is the 54th year of increased dividends. It's a small hike, but not unexpected given the industry that they're in. Parker Hannifin hikes the dividend by 10.1%. That is their 68th consecutive year. 68 years and still hiking your dividend by 10%.
Yeah, but I looked up the chart of this one. They have been growing their earnings quite rapidly. I think they 12% free cash flow per year annually over the last 5 years in growth. That's really a lot. It's a low yielder. I think something more than 1% or something like that. But I really would like to look a little bit deeper into this company and understand, like, how the heck are they doing this? It was really interesting for me. It's a motion and control manufacturer. You may know it a little bit better from your job.
Yeah, I mean, I was going to ask the question. I don't know how we've overlooked this. I know it's a low yielder, so it's probably not making our say screeners or metrics or whatever, but 68 years and the dividend growth rate is insane.
Yeah.
And all from cylinders, hydraulics, pumps, valves.
Yeah.
Sort of like an A.O. Smith kind of a company, which is also a good company. So I think this is a good company to maybe get our teeth into at some stage.
Exactly.
We also have another dividend aristocrat that we don't talk about much, which is W.W. Granger, ticker symbol GWW. That has another 10% dividend hike to 2.05 cents quarterly. I mean, I'm loving big hikes.
Yeah, and I also looked them up and I went to the website and they sell this industrial stuff like cleaning materials. Yeah, something like that. So no wonder that this company has so much dividend growth, let's say. So yeah, I mean dividend growth history.
Yeah. And then Otis, which make escalators, I believe, hiked their dividend by 14.7%.
Well, they're definitely building an escalator there with these dividend histories.
Yeah. And then the last one I have on the list here is MetLife, ticker symbol MET, with a 4.8%.
Yeah. That's an insurance company that I've looked a few times into, but I always shy away from it. Something, I don't like about it. I don't know what it is exactly.
Yeah, you have enough insurance. You don't need to look at one more.
That's true. That's true.
Okay.
Yeah, nice hikes, right? And really nice to see those aristocrats and the dividend kings just chugging along in their history. Really inspiring, I must say.
Yeah. And two, I must admit, that are not often talked about.
True. Maybe we should.
Yeah. So earnings. We're right bang in the middle of it. Let's start with Evolution AB. I know there's a lot of questions coming about these guys.
Yeah. So what we did today, right? We asked on Twitter the questions and on Facebook, like, okay, which earnings would you really like us to look into or to discuss? So let's start with Evolution AB. For people that don't know this company, it creates, let's say, online casinos. Yeah. That's what it comes down to. So live games, we had a whole episode about it not too long ago with Wolf of Arcor Street.
Right.
So if people are interested, I think it's 4 shows ago or 5 shows ago, just look it up. You will find it quickly. But look, the share price went down quite a bit after the earnings announcement. But to me, it looks actually quite solid. So operating revenues increased by almost 17%.
that's the headline number. But in this case, if you would take the currency impact out of it, it would be probably more like 24%. Now, we never used it as an excuse, but just to show that these numbers are very strong. Profit for the period was 270 million compared to 250 million. So much lower growth, 7%. Now, why is this? Of course, if the revenues go up double digits and the profit only single digit, it means that the expenses are high. Now, why are the expenses high? They have been hiring again a lot of people. They grew in a single quarter with more than 700 employees, which is 5% of the total workforce. Have you ever tried to hire 700 employees in a quarter? This is insane. They hired a bit more than 2,000 over the last years. Yeah. So what they are just doing, they're really increasing capacity really fast so that they can really follow the demand. Yeah. Because the demand for these online casinos are just rapidly growing. I think there was also today the annual general meeting where the CEO was mentioning, like, guys, we're now 12 to 15% probably of the entire market. But if you look at the generations and how they are using technology compared to a casino, this is likely to continue to increase for a very long time. And maybe even at a certain moment, live casinos will be more popular than physical casinos.
Yeah.
And I can very much follow this narrative, and their earnings show it. Yeah, their revenues show it. And also, I remember last year when the company got really punished on the stock market. I think it was in Q3 probably when I initiated the position. It was even written in the report, like we can't deliver on demand in Europe. So what yeah, I'm not surprised that their earnings are not growing as fast as the revenues. But look at Asia. Asia went from 181 million in revenue to almost 200 million in the last 3 months. That's a lot. That's more than 10% growth here in one of the largest business units. So really my head's off for this. So they are just investing for the future, and I must confess it reminds me a lot like ATN, the payment processor. It's not a dividend paying stock, but they got also hammered in Q4 last year because of their margin going down. And what were they doing? They were hiring a full bunch of developers at the time as well. And then the next quarterly report looked much better because it started to show the growth. So they are currently, what the CEO also says, very much focused on expanding the margins going forward. Yeah, now that they are hiring so many people, so they want to go back to it. But initially, it will be still under pressure, and they're just investing. And yeah, I actually liked a lot. I understand that short-term analysts, short-term focused analysts dump it. I hope that some people that didn't own the stock yet took that as an opportunity, because this company seems to be totally on fire. And that's a nice thing. If you have a founder in the company, they know when to invest, and they know they should pay the cost first before it turns into profit. So yeah, really for me, very solid. Really happy with my ownership in this company.
Yeah. And that, do you know what? That gives a good example of why you should read and understand reports sometimes, because looking at the numbers, you might see, earnings is down, but actually
Earnings are up, but growing
up.
less faster than expected.
Growing less faster than expected. But the reason behind that is because they're hiring more, which obviously points to the fact that the demand is there, which means that there will be higher growth in future. So I mean, good job.
They're also creating buildings and everything where the studios are in, and as Wolf of Hardcore explained us how it looks like. They're just very much investing. I love it, honestly, and I have high expectations from this company.
Nice one. I'll move to the other side of the world. I might look at Rowe Price, or American asset management.
Bring us back with the feet on the ground, please.
Yes. So this company is in quite a strange place over the last year. We know interest rates have hammered them. They've had net outflows over the last 12 to 18 months, and we can see that the share price has gone absolutely nowhere since June 2022. It's starting to look a little bit more positive for them. They have assets under management is up 15%, and that is despite outflows of 8 billion. What I actually found interesting about that 8 billion is that most of it was in equity strategies. So the equity portfolio, I think that was 12.8 billion of outflows, and the actual fixed income saw inflows of 5.5 billion. But then if you break that down even further, the outflows are mainly from retail investors. 7.5 billion from retail investors, whereas only 0.5 billion from institutional investors. That gives me a lot more confidence, because I know retail investors are more emotional. They will panic a little bit more in the market. So that kind of gives me a better picture of these outflows, that it's not as bad as it actually looks. And then assets under management did increase. They had a decent quarter again. The revenues increased mainly because of their advisory fees, which went up 6.4% over the quarter, which was quite strong. In turn, the revenues increased because that's the biggest portion of their revenue. So look, overall, I don't think the situation has changed. They're still under threat from these low-cost index funds. So we can see retail investors probably pulling out and moving into these, but we're not seeing that with institutional investors right just yet. But those threats still stay there. But as long as assets under management is growing, as long as they can keep growing their fees, their pricing, if they can become a little bit more competitive with their pricing, I mean, they have a rock solid balance sheet, and they're not afraid to say that in their investment, in their reports. So I'm a little bit more positive than I was this time last year, I have to say, on T.
Yeah, but look, they pay like $5 in dividends per share on an annual basis. They already made $2.50 in a single quarter. At this rate, they could make $10, let's say. So that means that the dividend is so easily covered.
Yeah. And look, they have a dividend yield of 4.25%. I'm not expecting a high dividend increase this year, but as we start to see a more positive narrative, we'll go back to the high digit.
Yeah, but maybe they turn the buyback machine again on.
Yeah, they could. They're cheap enough to do that. So it's an interesting company for me at the moment. I think the share price is at a decent level. It's been hovering there for 24 months or so. And I continue dipping into these companies. I think around $100, it's hard to ignore them.
Yes, exactly. And the good thing is, because you were talking about institutional, let's say, funds, or I mean, look at yourself, maybe at work. We have also such a fund where we can invest. There's a lock-in. Yeah, if you do this via work, your employer matches, let's say, you don't have really a lot of choice. The expenses are high. You know that you're getting ripped off, but you have a lock-in. Yeah, you won't sell really here, because if you put 3% in or something like that, and your boss matches 3%, then you have already 100% return. So you always do it. You always take it. An employer, they're not really likely to change either, because they are probably very comfortable. They don't care so much about the fees. What they most care about is that they are having something offered to that is simple and also probably easy done from procurement point of view. They don't really care about the fees that the employees pay.
Exactly.
Yeah, probably they get it even for free, because they know that gets the costs are paid by us as investors. So yeah, because of such a lock-in, I think that business has a bit of a moat. It's of course not a good business model, right? Poor user experience, let's say, but hey, it is what it is. But therefore, this is a typical example of a slow compounder. So you get a few years to make up your mind to see that this business is in decline or not. Yeah. So you don't need to worry as well on 1 or 2 quarters. Let the business fix itself. If it's after 2 years still declining in assets under management, the trend is not stopping, then you have a really good sign here. But the assets under management are growing again, so it's very simple.
They are growing, and outflows are decreasing. I think it's less than half than this time last year. So it's a lot more rosier, as you said. A lot of positives compared to last year. And look, the macroeconomics, the world is changing. We're not in this high inflationary rate that we were
Yeah.
12 months ago either. So it's more favorable for them. But we have seen that share price, as soon as there's some good news around that, it has popped quite quickly to 144, 150. So
Yeah. Yeah, not anymore the high inflation, but still the high interest. And I think
yes,
this is also normalizing. Yeah, maybe I can talk about it because I got also a question from Abraham. Give some thoughts on the Cibus Nordic real estate report. And look, I will not spend a lot of time on this, but I think they hit the bottom last year. What is very interesting is the net operating income by April 2023 was 111.5 million. Now it's 114 million. Yeah, in a high interest rate. So it was the hardest for them in July last year, but since then it has been crawling up because they have these rent escalators
yes,
and they start to kick in. So at a certain moment you get impacted because of the high interest rates, but this high interest rates becomes the new normal and it becomes your new baseline. And from this it continues to grow again and get back on track. So the profit from property management that they now have in potential is 96 cents. The dividend is 90 cents, so it's just covered. Last year it was still 111, but it went to, in a single quarter with this interest hike that we saw, it went to 91 cents. So it is like it was the bottom for them. They're in the new normal with this interest rate environments. They did really well with the debt management last year, and they're growing back to 96 cents per earnings potential now. Also, the debt to long-term value ratio is now nicely around 50%. It's also slightly improving again. So all in all, Cibus, I think, hit the bottom last year if the interest rates stay like this. And if the real estate market starts to slowly improve again in Sweden, then I think this company has a lot of room to recover.
you still hold them, right?
Yeah, definitely. I'm very much into this. They had at the time a very small dividend cut, like 5 or 10 cents, but this was always a high yield investment for me with a potential for growth. But I fully understood that during this situation, that the company is prudent. They pay almost everything out in dividends. It's a monthly dividend payer in Europe, one of the few. So that was not justification for me enough to sell them, because I see strong management here. And come on, guys, they are owning the real estate for supermarkets, right? It's the same to Defama, yeah. So very, very solid business, I would say.
I love that perspective now that it's now normalizing. So you have a couple of years of it not growing because of interest rates, but because you get so used to that, when you start to see that little bit of growth again, you forget about those 2 or 3 years beforehand.
Exactly.
Interesting concept. But we'll stick in Europe because we've got a couple of questions about Signify. I got one on Instagram from a guy who's known as V, and we got one from, I'm going to say Stephen, is what I would pronounce it in Ireland. But look, they got a high yield. It's 6.2% dividend yield. We spoke about them before on the company. I think they're a Philips spin-off. They do all these light bulbs, and it looks like a great company, but they dropped quite a bit since the last earnings, and that's because their sales declined by 12.5%. And that was actually a sharp decline. I don't think that management were expecting that much of a decline. So I tried to do a little bit of digging in the quarterly report as to why that declined. They had the usual, so weak professional sales in Europe, and in that professional segment in general, lower LED lamp sales by retail investors. So the likes of me and you going into our retailers buying LED lamps, and also retailers are actually returning to normal levels. We know we had all these scares where they couldn't get inventory, so they were overbuying, and that's now returning to normal. Then one thing, and I didn't know this, and it shows how long I'm out of the game. I used to be an electrician, as I told you. I've come out of that world, so I don't really keep up to date with everything. But fluorescent bulbs have been banned in Europe, and I knew there was talks of it, but apparently this came in 2012, but we're only starting to see the effects of that now. And that had a big effect on their sales. Actually, this quarter it was down nearly 33% in that segment alone. But what was also interesting was that the CEO he was pushed on it, but he declined to give any guidance in terms of sales for 2024. He says the market, pretty much he's blaming the ongoing difficulties in the Chinese market, the consumers and professional. There's a lot of volatility at the moment. And he said, just because of all these geopolitical tensions, we've got elections coming up in Europe, elections coming up in America. All these things are playing into the fact that he's not going to give any guidance on sales because it's too volatile. I mean, that gives me a good reflection of it's probably going to drop if I'm honest with you. I also did a lot of digging, and even though that market is expected to grow over the next 3 years about 6% annually, Signify is actually expecting to stay flat over the next 3 years. So it's a market that's I wouldn't say in trouble, but it's stagnating due to a lot of processes outside their control. So it would be actually interesting to do a deeper dive on these. I know that it has a 6.2% dividend yield, and that can be quite attractive. It has a good business. Their products are great. I think we all have their products in some way, shape, or form. But it's just to understand over the next 3 years, will there be a better opportunity to buy these? Will they continue to drop? And if they do, will that dividend still be safe? That said, their free cash flow has increased because I mentioned earlier, inventories are returning to normal. Their own inventory is now decreasing. It freed up some working capital, hence their free cash flow increased by about 30%.
So they're selling out of inventory.
Yeah, exactly.
That's
which is not bad.
Nice.
Which is not a bad thing. So I think there's some positives and some negatives here. I think if you're a long-term investor, if you can look past maybe the 2, maybe even 3-year mark and maybe think 5-10 years out, it could be a decent investment. But I think this company, I think I'd like to do a deep dive on this actually, because it's
nice.
I think it's an interesting moment to look at them when they're in trouble like this, because to me it has a good business model.
Yeah, nice. And we know that usually the Philips spin-offs do much better than Philips themselves.
It's not hard.
No, exactly. Okay, hey, then we have to talk really about the elephant in the room, I think, for European dividend investors, and that's Unilever. And Erik Made on Facebook, I think he asked the right question here that many people have on their mind. Unilever, is it back? Now, why this question? Unilever started to grow again. Can you imagine that their sales growth was 4.4%? And I really wanted to call out here, 2.2% of this was volume growth. Yeah, how amazing this is. Not like just hiking the prices and such like a madman to protect sales. No, actually, people are buying more of the stuff. So that is already like music to my ears. Yeah. Well, it's very interesting actually that in total they made 15 billion in the first quarter. So that was a 1.4%. How is it? I think 1.4. Okay, no, I'm looking wrong. 4.4% growth. And then, for instance, beauty and well-being is doing really well. 3.2 billion turnover, 7.4% growth. It's by far the biggest one, and then personal care. And we know that also the CEO is very much investing into these. And then the ice cream business, 1.8 billion, and at the bottom with 2.3% growth. Yeah, as such. So what's also interesting, what they call the power brands. Those are those big brands, also those 1 billion brands. They generate 75% of sales, have been actually the drivers of growth by 6.1% growth and 3.8% increase in volume of this. So this is really, really strong. And I would say these are the early signs that the CEO is onto something with a strategy. Yeah. Their outlook also, they expect the underlying sales growth to be 3 to 5% and a small increase in the margin. Now, what I found interesting was the regional performance. Latin America, 9.5% growth, of which 8.1% volume. What happened in Latin America? It has been the strongest grower of the regions. Also, North America showed growth. Asia showed growth. Now here it comes. Europe also showed growth of 4%, but 1.5% less volume and 5% 5.5% more prices. So yeah, they are just ordinary hiking
Yeah,
on us.
we're getting screwed over here.
Exactly. Now, and then I want to talk a little bit about also the transcript, right? So if you go into an earnings call, you can listen to it. I had no time for that, so I just read this transcript. And they were also talking about the allocation strategy. So in what the CEO mentioned, and I come again, in terms of capital returns to shareholders, we remain committed to an attractive and sustainable dividend. So the growing dividend doesn't exist anymore for them. Attractive, we know what it means from AT&T. Sustainable, that means like if they can afford it. So whenever they can't afford it, they will probably do a max payout of the dividend, but not above 100. So that will probably mean like a dividend cut. Of course, we wouldn't like to have a company that is borrowing money either for the dividend, right? So however, we wouldn't like one bad year to see a dividend cut. Now, if I look at the statements, that's more on the table then. But what I don't understand is that they want to do 1.5 billion share buyback program still in the second quarter that they will start. Now, I did check the cash flow statement because there's a sales update. Yeah, they don't give us a cash flow statement now or income statement. But I checked the cash flow statement from 2023. And they had enough cash coming in. I think they had a 60% dividend payout ratio, so they can afford a 1.5 billion share buyback. But then I think, like, why don't you just pay down the debt? Why don't you just be a bit more frugal? The issue here is, I guess, that Nelson Peltz is in the board, and he likes, of course, this kind of stuff because it pumps up the share price typically. On the other end, maybe the only good thing for us as dividend investors, if they buy 1.5 billion back, maybe it gives us a 1% dividend hike next year. Who knows? What they also did is, and this is what I personally like, they reintroduced the relative total shareholder return as a measure for their bonus. Yeah, and this is good. It was about time that they do this.
Yeah.
Because it was too much focused on other stuff. Yeah, so at least it's not anymore only on return on invested capital, sustainability. It is also now like show us the money. Yeah, to what is it, McGuire?
Yeah.
Show us the money. Yeah,
Show me the money.
Yeah, exactly. This is what it is about now, and that's good. So our incentives start to be aligned again with Unilever. Except for the dividend policy, which I still find a little bit tricky.
I think, honestly, I think they're priming us for the dividend cut. If you think of the last CEO, Alan Yopi,
Yeah,
right, he was criticized because the share price was going nowhere. Investors were not happy because the share price was going nowhere. So the key metric, and you mentioned the activist investors, the key metric for them is the share price. What's the best way to, when you start to see us coming back to growth, what's the best way to prop that up? You buy back some shares, you reduce the share count, and you should increase the share price as a result of that. If they have to do that at the expense of the dividend, I think they will, because I believe that their priority is in share price growth and not the dividend. That's just my opinion.
Yeah, but if you study Nelson Peltz, he was also at Procter & Gamble. They just fixed the business and kept the dividend growth intact.
American companies are different than European in terms of dividend behavior.
That's true. But I count on him to help fixing the company here. This is an activist, so he looks at companies that are poorly managed, and I'm on the fence with this one. It's definitely on the watch list. But when I see this, it is kind of starting to tell me like, EDGI, don't be too early with selling.
Yeah,
just watch another 1-2 quarters.
I think it all comes down to the CEO strategy, but they've also mentioned it there, the importance of underlying sales growth. You just need to keep an eye on that. Is that making a meaningful impact?
Exactly.
I know Latin America grew, but it's not the biggest market. You need to see that in Europe, you need to see that in Asia, you need to see that in America. So I think that's the marker.
Yeah, true.
Interesting.
All in all, I think a good sales update. I don't know what it meant bottom line. We will see that in the summer. Yeah, but from a sales point of view, it looks Like I said, one swallow doesn't make a summer, right? But
Yeah.
it is a nice swallow.
But hey, it's been a while since we had a positive sales update, quarterly sales.
Exactly. You can see the smile on my face.
Yes, of course, of course. So let's take it when it comes along.
Yeah. So now, okay. Next one then. Tell us a little bit about Joey.
Joey at Agree Realty. I
Yeah.
mean, this company's becoming a little bit like clockwork for me, because honestly, it was another strong quarter for them. Actually, so strong that they have introduced a adjusted funds from operations share guidance, which they reluctantly never ever do, and they were questioned hard on this in the questions because they never do this. Why are they doing so now? And pretty much Joey has come out to say, okay, given that there's a lot of uncertainty in the macro environment, it's a pretty crazy world. He says, we are just a boring net lease real estate investment trust. That's all we are. And we're trying to provide some clarity, some certainty around what we're doing. And he goes on and talks about his investor deck, how they're consistent, their fortress balance sheet, and what they're buying. They stick to their plan, they stick to their lane. That's why they're so confident in their adjusted funds from operations guidance, which I think, look, it's quite positive. It was nice from and refreshing for him to say that. The guidance that he did give is roughly around a 4.2% growth in 2023, which is not too bad given the high interest rate environment that we're still in. During this quarter, they've invested roughly around 140 million in 50 what they call high quality net lease properties. We know that they typically stick to that. 70% of their portfolio are these investment grade compared to Realty Income, which is a lot lower than that. So they're sticking to that mantra. They're kind of sticking in that lane. AFFO for the quarter was up 4.6% for the quarter. So I think that's going to be the playbook for the year. And of course, they increased the dividend by 3%. So look, I think it's been a positive update from them. There's not much else to say about them really, other than they just keep ticking over. I mean, it's a hard environment, we know, for real estate investment trusts, but we still seeing the growth. We're not seeing
This just well managed company. And
yeah.
I went also to the presentation that they shared, and there's one in there. It's about, this title is called Investment Foresight, a deeper dive into ADC's thought leadership and track record of execution. What do you think is in there? It's a story about Walgreens. How
Yes.
Walgreens in 2013 was 27% of their their tenants. And then they said, like in Q1 2019, they said, I think the pharmacy space in general really has some work to do on the front end, predominantly of those stores. And we like to see some ingenuity and creativity driving traffic into those stores. Q1 2021. With this transaction, CVS has surpassed Walgreens as our largest pharmacy tenant. We continue to favor CVS as the sector leader, given their innovation and adaptation to consumer preferences and overall market dynamics in the pharmacy space. 2023, Walgreens downgraded to Baa3 in Moody's in January, downgraded to BBB minus, and downgraded to Ba2 by Moody's in December. It's like a giant middle finger to one of their tenants, and they reduced it from 27% in 2013 to 1% right now.
Yeah, it's that sounds like a Taylor Swift diss track at Walgreens, is what that sounds like. But I mean, you can see it. Like CVS are their fifth highest tenant at 3.2%, and Walgreens are not even in the top 20 here. They're gone.
But that's so nice about this. So what the CEO effectively demonstrated is, like, guys, we watch our tenants, we watch how they perform, and if they don't perform well, we'll manage them out. And probably it means, like, either we don't grow with them anymore, or we try to hand over parts of the portfolio. But we will definitely lower our exposure. So he's really looking at it as an investor.
Yeah,
But that's so funny. These are tenants, these are customers, but he sees customers as an investment.
I wish you had a conversation with me in 2021. I wouldn't have invested in Walgreens.
Well, you should have just read his reports.
But I mean, I love that. I love that about this company, that they are treating it like investors, because it means they are aligned with me. They're looking at this. They want cash flow coming in.
Yeah.
And we know they have to pay out 80 or 90% of that to us. So that's all he's interested in. Can he keep that growing? And if you're a tenant and your investment grade is going downhill, good luck to you. And I love that about him. And he's such a really interesting CEO as well. I love actually reading his answers. He's so articulate, but he's straight to the point. I don't get a sense of BS. I don't get any.
Exactly. Yeah, no. I mean, I'm a happy shareholder, must confess.
Yeah, me too.
Good. Then maybe the last one, and I took this one, Bristol Myers. We had Seb, Maciej, Dauko, MH79 all asking about Bristol Myers Squibb. What happened? Bristol Myers, I think, was trading around $52, now at 45 after the earnings. It went down. If I look at the reports, it's not so bad, honestly. So they did make a loss here, but we'll come soon to that. First of all, their revenues increased to almost 12 billion by 5%. So that's the good news. They've been buying a lot. They bought Carona Therapeutics. They've effectively buying a pipeline. The issue is that they have, I believe, two products going. Patent expirations. So for Eliquis and Opdivo. And Eliquis and Opdivo, I believe they are both their top-selling drugs. Yeah, they bring in total 5.7 billion out of the 11.9 billion, so almost half of the portfolio. Yeah, so and that's a lot. What I did on my back on a napkin, back on a napkin calculation when I did this. Okay, then the multiples are currently priced in that there will be almost nothing left, right? So this is also how you can keep yourself sane. You don't need to always do complicated analysis. You can also just look at the multiple that you pay for it now based on the earnings, and then thinking like, okay, let's say if it's 7 or 8 now, okay, let it be 18 when the revenue disappears, or 20. What is for me very interesting here is that they had a one-time net impact of the acquired intellectual property rights for development charges, which was $6.30. And this has all to do with the Carona Therapeutics acquisition, because they just bought the pipeline there. Yeah, it is supposed to become a multi-billion-dollar sales generator if they get FDA approval on the 26th of September this year. The company is very convinced on this because if they look at if you think about getting drug approval, right, there are two things here. You either need to have a better product at the same price, or the same quality of product at a much lower price, but there's patent protection there, right? But still, if you can treat it the same, then you typically get reimbursed. So it doesn't need to be naturally the same, let's call it compound or something like that. But this is how governments and health care, national healthcare funds look at this. If you want to reimburse, it needs to be better than what we have already. And this drug that they are looking at here is effectively just giving a 30% improvement in about 75% of the patients that they were having in their clinical trials. So they're pretty bullish on this one. And I believe it's something that's targeting schizophrenia. So it's also a relatively large market. So yeah, mark in your calendar as a Bristol Myers investor, the 26th of September. I expect the price to pop if it gets an approval, and I expect the price to sharply decline if it doesn't get an approval, because then they have a big issue with debt that they just are. Let's say a company that they just bought on some debt. Yeah. So yeah, I think this laws that they made because of this impact of these intellectual property rights from accounting methodology means that they also had to lower the outlook. Yeah, so they have now an outlook, instead of $7 and something, they have 40 cents because of the almost 630 decline.
Yeah,
And yeah, that makes people not happy. Yeah, simply said. And that's why I think the share went down. I don't have any other reason, because all the rest is known already and they've been growing their revenues. So yeah, they're also at the moment, I said, they're also having a cost savings program in place. They want to pay 10 billion down in debt over the next 2 years to strengthen the balance sheet again. They have 5 billion in share repurchases authorized per now, effectively, so they can buy back. Do you know what the market cap at the moment is?
The market cap is 90 billion.
So yeah, they're effectively able to buy back 6% of their shares. So all in all, for me, the investment thesis still stands. I think they have strengthened the pipeline like Upfi did in the past, but in this case with a product that still has to be approved, and so there's more risk associated to it.
Yeah, and that's what you're paying for, really. You're getting a 5.3% yield at the moment. Is that enough to take on that risk? Because as you said, 26th of September, you'll probably know before that if it's going to be approved or not going to be approved. But that's going to tell us if this thesis will play out or not, I would imagine.
Yeah, but imagine, yeah, okay, we don't even need to go into this. Well, maybe then, okay, imagine that you wouldn't have this impact of this intellectual property rights because you didn't buy the company. Then the company would have been making between $6 and $7 in earnings per share at a $45 share price right now.
Yeah,
we're talking about a 7 multiple. Yeah, so a lot is priced into this. A lot is priced into it.
Yeah. It's always.
So this is why it's hard to invest in pharma companies. You need to buy the pipeline. You need to understand the pipeline a little bit. That just makes it really hard.
I said that last week, and I got some comments. Actually, didn't get a chance to write back, but one of them is, why not invest in real estate investment trusts that invest in these types of companies, or where these companies have to lease their
offices. Yeah,
that's an interesting concept as well. Yeah. But it's a tough one. This one, it's all over social media. It's one of these popular ones that kind of gives me the feeling of AT&T at that time when everybody was buying it because it was high yield and stuff.
Yeah.
And to me, the risk here is obvious, and it's why I don't have that conviction.
Yes.
But I hope it works out for you, because I know you have good conviction and you're not usually wrong, I have to say. So
no, but I mean, Bristol Myers for me, it's a tier 4 stock. So it won't have a big impact in my portfolio. If it goes wrong, it won't have a big impact in my portfolio if it goes well. Yeah. Downside is limited. The downside I have is losing $45. The upside is unlimited. Yeah. That's how I look at this. It's more of a, well, no, yeah, it's a value play. But, for me, it is still, it's not a very safe dividend profile, but relatively safe if you look at the cash flows and what they should be able to afford also once the 2 drugs go off patent. So, yeah.
Nice one. I think we'll move on to some business questions.
Let's do it.
Morpheus is first up, and he has a question around the number of stocks in your portfolio. He has roughly around 30 stocks. It could rise to about 33 stocks, depending on his wish list. Some people think that this is too many stocks. What do you think?
Well, I've got more than 40. I think at the moment 42. For me, the ideal number is around 40, because then if you take my tier 1 and 2 tier 4 system into consideration, then the largest size that I can have is 4%. If a dividend will be totally cut till zero of one of my tier 1 companies, which should be of the highest of quality, then I would lose 4%. That's how I look at it. And then actually 30 stocks would be too less, because I don't want to lose more than 5% potential in dividend income if someone cuts the dividend. So I understand why people say this. When you have 30 stocks, they say, okay, you need to do a lot of homework. I kind of tend to disagree. If you know the stock, you just look for a few minutes into the report, and that's it. And I don't do it for many stocks or for all the stocks. I do more than others, or more than I would usually do, just because we have a podcast where we love to talk about this stuff. Yeah. Um,
I,
yeah,
I think if you're a well-connected investor, let's put it that way, you
yeah,
might have a more concentrated portfolio. But
true.
for the average Joe, where we rely on news, probably third
Yeah,
hand, and coming from investor relations, where we're probably only they're trying to paint it in a way that's
yeah,
positive. I think having 40 stocks, 30, 40 stocks is not a bad thing.
yeah,
If you're an investor that is well connected in terms of politically and the
yeah.
group you go around, you could take the risk and have that as 3, 4, 5 companies.
Yeah,
But
that's true. But you need to also think a little bit from the other side, even. Generally, the theory is I believe that if you own more than 10 stocks, you don't necessarily really much diversify yourself more after that if you have those stocks not so much correlated with each other. Yeah.
yeah,
So if you just buy one stock from each sector and you buy the best one, I mean, in number one or something like that, that has some still wind in the back, let's say, then having 10 or 30 doesn't make that much of a difference from a diversification point of view. I think this is very much total return investment focused. For us as dividend investors, like I mentioned, I look totally different at this. I don't care so much about the capital gains. I know that the share price grows if my dividend grows. Yeah, because it means the earnings are growing as well. But I just look at it, okay, how much can I afford to lose in dividend income if someone cuts the dividend? That's the question I try to answer. And then 40 is for me ideal.
yeah. So for you, it's income protection, and that's essentially what you do. Not
Exactly. Income protection, not
diversification.
yeah, and not trying to be on the you bring when you have 10, you have also increased focus on those holdings.
Yeah.
You can spend more time on those holdings. You get just more focus and you're probably more efficient. But yeah, that's a total different investment style for me.
Lawrence has asked us about the boring middle bit. You've often spoke about it, but when does it start and when does it actually end?
So, I mean, the boring middle is the moment that you have read all the books and you don't have hunger anymore to buy a new book. If you have studied so many companies that you don't quickly get surprised anymore by new companies. Yeah, so you know the Coca-Colas of the world, the McDonald's, the Unilevers, you know them. So, yeah, you don't discover really any more new companies at a certain moment. You don't feel like you learn a lot of new stuff anymore. So this curiosity is not anymore really fed. Means you probably start spending your time elsewhere, but you started a plan which takes 15 to 20 years. Yeah, so that means you still need to have this kind of dollar cost averaging, and that is, I think, where the boring middle part starts. And yeah, I'm probably in it, but yeah, we have the podcast, right? So we have the newsletter. So that keeps me very busy, and I keep running into things because of that nature of work. But I think that's where the boring middle starts, and then you know that, and you will know, when you're in it. When you don't know yet that you're when you're in it, then you're not in it.
You know if you know, and then I assume it ends then when you reach financial freedom or you reach your goal.
Oh, what I understand is like if it comes closer, like 1 year or 2 years before, you get kind of this anxiety starting to work here. Like, okay, what to do? Oh, wait, this is going to be real. Yeah.
Yeah.
So I'm getting closer and closer to that stage, I think.
Yeah. Lucian has asked us, do you guys know any good preferred stock ETFs that can be bought by us from Europe? I don't.
I don't know.
Not off the top of my head. Have to do some research on that. Jack has asked us to pick 3 American dividend growth stocks to invest all of your money in. What would they be and why?
Well, for sure, Microsoft. I'm not thinking about the yield here now. I'm just thinking about the long-term quality. It would be Microsoft. I would have usually said Johnson and Johnson, but no, not now. Maybe just because last week I did a deep dive on Starbucks that I will say Starbucks. I don't see this company losing market share anytime soon. So Microsoft, Starbucks. And you first. I'll think about the third.
Yeah, I'd probably put Coca-Cola in there if I was to pick one again. If you're putting all your money in and you want it to be relatively safe, have okay yield without taking too much risk, I think you can't go wrong with Coca-Cola.
Yeah. Then I would take McDonald's actually, not Coca-Cola, but McDonald's. I think.
Yeah, McDonald's is a good one as well. It's a good one as well. So I would tend to stick to probably consumer staples. It's a hard one actually without thinking off the top of your head. Coca-Cola stood out for me as they are iconic. I'm heavily involved in real estate, but would I put all my money in them? No, I would not.
It's a different sector.
Yeah, it's a different sector. So I mean, it's tough. Pharma, I'm not really involved in, so it's hard to pick three. I have to say.
Yeah.
I don't want to just throw three out there. I think I might have more conviction over European stocks lately.
So you would just buy one. You would
Yeah,
put
just
all your wealth in Coca-Cola.
everything in Coca-Cola and go to sleep and wake up.
I would love to see you pressing that buy button where you take almost your 100K portfolio, you sell everything and transfer it into Coca-Cola. I would love to have a live Twitch, I think it's called, for this and see your face.
A live feed and the sweat coming off me and shaking when I'm pressing the button.
Exactly.
Andre has asked us about Kering, ticker symbol KER on the Paris Stock Exchange.
Yeah, he asked if it's a buy for the long term, and we don't give these kinds of recommendation, Andre, because then you're asking kind of investment advice. But look, facts are revenue declined 11%. Yeah, they say an adverse macro drop, challenging volatile market conditions in APAC. Gucci 21% down. Yeah, so that's really the big one. Eyewear is doing really good, by the way. If I look at the brands that Kering has, and then I compare it to LVMH, who had also weak sales in APAC, but still like flattish. But then in Europe it was growing nicely. When I see this, and Gucci is like 2 billion, so 40 to 45% of their revenue. This is just too much sensitivity. Anyway, who buys Gucci? This ugly stuff. But that aside, I would never buy this stock probably. Yeah, so
yeah, I'm the same.
If you know that Louis Vuitton exists, then yeah, I find it inferior because I've been studying LVMH for the newsletter. And then you also look a little bit at the competition, and I think LVMH, but also Hermes, they are just superior in management and what they do. Also more diversified.
Good. Oleg has asked us, do we ever consider small cap stocks, such as Data Group or Mensch und Maschine from Germany?
So yeah, I've got Defama from Germany in my portfolio. I've got Chesnara from England, a small insurer in my portfolio. So yeah, I do consider them as long as they have a safe dividend and a good dividend track record. I wouldn't want to have too many of them in my portfolio, but a few, there's definitely place for it. And I believe that you are intending to look at Mensch und Maschine for a deep dive in the next newsletter.
Yeah, of course. And we got a couple of comments and emails after the last podcast, because I believe you said that Autodesk was a part of that company.
Because I went to the product page, but they seem to be a reseller.
They're a reseller. So
my apologies.
We get pulled up quite quickly, which is also
that's good. Yeah, that's good.
Yes, I will be looking at that company this week and next week. So I'm interested and excited for that.
Yeah, I'm also really looking into it because CAD systems and such. Once you're in there in the industry, you have quite a lock in there. Once engineers get educated with it, it's hard to get them off this software.
Yeah, it is. It is. Well, we're simple guys, us engineers.
Yeah, but that's exactly what you need. So
Yay Didier has asked us about our thoughts on a ticker symbol called WINA. It's a small cap compounder with extraordinary margins.
I don't know this one. I would need to look into it. I'm sorry. Yeah.
Okay. So yeah, with that in mind, I will be doing that deep dive on Mensch und Maschine. I'll probably try and pronounce it a little bit better as well. But that is the end of the show. Thanks to everyone for all our questions. We did get questions in around earnings and stuff, which we tried to answer for our earnings updates as well. So thanks very much to everyone who has suggested these companies. And hopefully you enjoyed it. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.